Does this mean that we should be jumping back into EMs right now?
Well, look, I think it might be a little bit premature to catch the proverbial falling knife, but as you highlighted a moment ago, we do think that the sort of growth pessimism that has creeped into the market is going a bit too far. I mean, in the first half of the year, we had unbridled optimism about growth. We had fears of inflation, and it feels like we've shifted very rapidly into a world where everybody's all of a sudden worried about the downside. So I think what's really going on is that people have had to adjust their growth expectations. We have things like copper and oil down 15% from their highs. And I think that we have, a number of emerging markets trading at significant discounts to their developed market peers. So we do think there are going to be opportunities presenting themselves, but it might be a little bit premature still to jump back in.
Especially at a time when it looks like everybody is now more bullish on the dollar, as this GTV chart on the Bloomberg shows. Will that act as a headwind for emerging market assets? And when could we see some dollar weakness next?
Yeah, look, I think that's a great question. And typically when you have these sort of global growth concerns and sort of risky or pro-cyclical assets under pressure, the dollar tends to do a little bit better. However, it's our contention that the growth outlook for a number of economies in Asia and across EM are actually in relatively good shape. And as we get past the uncertainty about the Fed's tapering announcement, which we do not expect to cause too much volatility, we would expect the US dollar to start coming back under pressure in the latter part of the year.
Eric, when you take a look at the difference between, say, how the RBNZ and how Australia still continues to try and handle COVID, with COVID zero still being the ultimate goal versus the rest of the world, does that make a difference when it comes to the attractiveness of assets, particularly as you see what happened with the Kiwi dollar and other Kiwi assets just this week?
Well, look, I think you raise an important point, and that is that, we're in a world now where a number of central banks are talking about taking away some of the emergency stimulus measures that we've seen. The RBNZ is a great example. The Bank of Korea is another example. In both cases, we expect rate hikes before the end of the year. But bringing it back to this zero COVID strategy, I think it does raise quite a bit of uncertainty because for those economies or those countries that are not yet prepared to live with the COVID scenario on the ground for them, it means that they're vulnerable to even a small outbreak of COVID, like we've seen in New Zealand this week. And I think that creates an enormous amount of market uncertainty in terms of trying to anticipate when the central bank will or won't move. I think the market was prepared, as we were, for a rate hike in New Zealand this week. And with the recent lockdowns that we've seen imposed, that has changed the calculus in the very short term. So I think it creates quite a bit of, in my opinion, unnecessary uncertainty.
You talk about enormous uncertainty. We've got to head to China, of course, with just the extent of the regulatory crackdown, the target still pretty unknown. At what point do you, or can you, let me phrase it this way, can you even say, you look at a Chinese stock, a Chinese tech stock, a consumer-facing stock and say, it's adequately discounted now?
Look, I think it's this is one of the big challenges for sort of global equity markets today, which is how do you price in or how do you make a guesstimate for how much policy uncertainty to account for. I don't think the regulatory pressure in China is over. We've seen Xi Jinping and a number of policymakers in China talk about the need for a more equally distributed amount of wealth in society. That is going to have implications for not only the technology sector, but perhaps the education sector as well, perhaps real estate, and a number of the traditional drivers of growth in China's economy. Now, it is our view that with significant political developments and scenarios next year, that China will maintain economic stability. We're not expecting a huge amount of volatility in either the bond or the currency markets. And so I do think that fears over China's growth slowdown are premature. That being said, I think we have to accept that there will be further policy pressure in the near future.